Something really strange is happening in the stock market right now. While you hear all this talk about all-time highs, there's a whole other story unfolding beneath the surface. A silent bear market is absolutely crushing some of the biggest names in software. So what's the deal? Let's dig in. So, just to give you a picture of how wild this is, look at this. On the exact same day, you could have a stock like Meta make someone $17,000 richer, and in another corner of the market, a giant like Microsoft could drop 58 bucks a share. I mean, how is that even possible? It's like we're living in two totally different markets at the same time. And that really gets to the heart of what we're talking about today. You've got the big indexes, the S&P 500, the NASDAQ, they're all floating near their record highs. But behind the scenes, a brutal, hidden bear market is just hammering some of the best companies in the world. I mean, if you just glance at the headlines, everything looks great. The Q2Q, which tracks the biggest tech stocks, is down, maybe 1.5% from its peak? It's like looking at the surface of a lake on a calm day. Everything seems perfectly fine. But oh man, if you look under the hood, it's a completely different story. In the world of software stocks, it's not calm at all. It's an absolute bloodbath, a massive sell-off that the top-line numbers just don't show you. All right, so let's really dig into the damage here. And we're not talking about some small, risky companies either. We are talking about the titans of the industry. I mean, just look at these numbers. They are absolutely brutal. Snowflake, down 26% in 3 months. Salesforce, down over 20% in just 1 month. Adobe, almost 18%. Intuit, another 26% drop. And ServiceNow, just demolished, down almost 40%. This isn't just a little dip. This is a full-on collapse. And what's so crazy about this is that just a few months ago, these companies were the darlings of Wall Street. Everybody was saying they had the greatest, most predictable business models in the world. And now, they're getting thrown out like garbage. So what on earth happened? So when you see drops like this, I mean, the first question that pops into your head is, should I be panicking right now? Is this the end for software as we know it? Is it time to sell everything and run for the hills? Well, according to the investor we're following, the answer is absolutely not. In fact, they believe this isn't a crisis at all. It's actually the complete opposite. The big idea here is that Wall Street is totally freaking out. They're spooked that maybe new AI tools are going to come in and disrupt these software giants. But the thesis is that this is a massive overreaction. And when you get that kind of fear, it creates a huge gap between the price of a stock and its real value. And that gap, well, that's where opportunity lives. And look, this isn't just some theory. This is putting your money where your mouth is. Our source took $60,000 and plowed it right into these stocks on one of the worst days of the sell-off. Now that is a serious bet against the herd. All right, so where exactly did that 60 grand go? Let's get into the nitty-gritty and look at the actual investment case for 3 of the companies they bought. First on the list is Salesforce, or as our investor is calling it right now, Slamforce. Pretty fitting, right? The stock has gotten absolutely hammered, but when you actually crunch the numbers, a very different picture starts to emerge. So let's look at the numbers from their model. In what they call the base case, they're projecting a potential return of 25 to 30% a year, every year, for the next 4 years. That is a massive return. But that's not even the most interesting part. Here's the part that really got my attention. Even in their bear case, their worst case scenario where growth gets cut in half, the model still projects an 11 to 17% annual return. Just think about that. Even if things go kind of wrong, you could still beat the market's long-term average. That is a huge margin of safety. All right, next up is Adobe. And the assumptions here are frankly super conservative. They're only plugging in 8% revenue growth and 10% profit growth. But even with those pretty modest numbers, you're still looking at a potential 21% return per year. You'd have to believe Adobe is basically falling off a cliff for this not to be an attractive price. And the third one, a new buy, is a company called ServiceNow. Think of ServiceNow as the digital plumbing for massive corporations. They build the systems that automate pretty much everything: IT tickets, HR requests, you name it. And once a company's running on their platform, it is incredibly painful and expensive to switch. It's what you call a very sticky business. And this is where the long-term story gets really exciting. The bet here is that ServiceNow can keep growing its revenue by 15 to 25% a year, not just for a couple years, but way into the 2030s. Now, when a company's growing that fast, for that long, paying a price in the high 20s for its future earnings, suddenly starts to look really, really cheap. Now, it's really important to get this next point. This isn't just about buying anything that's fallen off a cliff. To really drive that home, let's look at a company from a totally different industry to see what a trap looks like. So let's talk about a company like Micron. They make memory chips, and the stock has been on an absolute tear thanks to all the AI hype. On the surface, it looks like a slam dunk, right? But is it easy money, or is it a trap? You see, the memory chip industry is what they call cyclical. It has this classic boom and bust cycle, and it goes something like this. First, there's a huge boom in demand. Right now, that's AI. Prices and profits go to the moon. Then, all the competitors rush to build new factories to cash in. But eventually, demand cools off, and suddenly there's way too much supply. Prices crash, profits disappear, and the stock goes nowhere for years. So even though things look amazing right now, it might be the worst time to buy. So when you put all this together, what's the big picture? What's the main takeaway here? Well, it really boils down to one thing: being able to separate the short-term noise and panic from the long-term reality of a business. You know, it actually reminds me of Warren Buffett. There's a reason he lives in Omaha, Nebraska, and not in the middle of Manhattan. He says it's so he can think with a clear mind, away from all the craziness and the overreacting. It's about tuning out the daily panic and focusing on what a business is actually worth. And that's exactly the philosophy behind this big bet on software. And that really leaves us with a question for you to think about. When everyone else is panicking and the market is freaking out, do you join them and see nothing but risk? Or do you take a deep breath and start looking for the opportunity?